Good day, everybody. It's Greg Schnell, and I am here with the July 13th edition of U.S. Market Review. So thanks for taking the time to join me. Lots in this one this week. New highs across the U.S. Interestingly enough, rest of world forgot to show up for the party. So some divergence, and so we're going to work through a lot of that on the presentation today. So, to find all of my blogs, StockCharts.com, articles tab, drop down menu on the right, and then it's the Canadian Technician, or Don't Ignore This Chart, or Chart Watchers, which just came out this weekend, and they accidentally forgot to get my article in there, so I'll attach it onto the bottom of both my Don't Ignore This Chart and Canadian Technician in case you missed it. Please hit subscribe at the bottom. Obviously, that helps us. So if you could help me out, if you're interested in getting that in your mail weekly, that would be great. And contact information, gregs@stockcharts.com, and Twitter @SchnellInvestor. And our agenda today, here we go. Have to be bullish with new highs. I must admit, watching everything else kind of not do great and the US go up alone gives me a little pause, but the tech still rallied. So I think until the tech stall, we have to stay bullish. Big tech pushed higher, energy turning up along with gold. So we got a buy signal across the energy sector this week, or across the fossil fuels energy sector this week, with oil, gasoline, heating oil, natural gas all above the 10-week moving average. So things are going there. And gold was trying to rally. There's some important inflection points in gold I want to talk about. Transports and semis both had a good week, which is bullish, and we should consider that. So that's good. Russell and the TSX, not great. The TSX is unable to break out so far, and the same with the Russell. Just kind of trapped in this sideways price action, which isn't that good. Shanghai with a big rollover, and that's at odds with the energy and the gold turning up. So that's kind of confusing. And industrial metals still continue to look okay. So struggling to figure out the gap there. So we're going to talk about that. Anyway, definitely something to watch for. And Japan, no one got the invite. I mean, they have basically ignored the entire rally. So we're going to cover that off a little bit. And then the rest of the world was an entire pullback week. So again, really an interesting week from a macro perspective. Let me go get one thing here, and maybe it's just a screenshot is probably the best way to go get it. So here's my desktop, and no, I think it's, let me think about it. This one. Yeah. So this is how the commodities ranked this week, and you can see the crude oil did pretty well, but the rest were weak. But the chart I want to show you is the one with everything else. So file open, and I just think it's here. No, that was the wrong one. Okay, so that was the third one. Let's go grab one more. File open. Right. There we go. So this was kind of the reason I was a little bit shocked, just how bad everything else did. Like, look at Germany down 2% here, India down 2%, Shanghai down 2.67%, even Russia and Brazil that have been performing well, both had down weeks. Now, again, you're allowed to have a down week. It's just at so much odds with the U.S. breaking out to new highs, and while it does that, everything else rolls over. So anyway, that puts it on the, hey, what's going on around here list, and we're going to cover that off. So anyway, let's get back into the charts here and roll through them. So from a breadth perspective, we're a little bit weak here as we go through to try and break out to new highs on the NASDAQ. And again, this breadth indicator here has not been running up as you might expect. So the NASDAQ's been okay. I mean, this is the same sort of trend it was on since the beginning of the year, back on that same sort of trend. I think we'd be watching for that to break, because one of the things that concerns me is we haven't broken out to a new high. But Arthur Hill wrote a great article on advanced decline lines, and that's right here. It was in the Chart Watchers newsletter this week. So I'd encourage you to go read that, but I've incorporated one of those charts into this presentation, and we can go through that in a second. So the NASDAQ high lows we're still stuck in this range. It just can't get going. And again, here in 2014-15, we had the same sort of flicker. Doesn't mean we can't go up. What we're wondering about is, are we going to be back in this sort of mode in here? So, but at this point, it still looks like we're in the bullish part of the trend. So everything looks good from a high-low perspective on the NASDAQ. On the New York, we broke out to new advanced decline line highs a long time ago, way back here in February. And you can see that the market is trying to break out to new highs here. And I think it did hit a new 52-week high here. I don't know if it closed at a new 52-week high on a weekly chart, but we'll see. Dow Jones, again, this is the high-low information is starting to show that this has got enough stocks making new highs to be very bullish. And I mean, we can go from that, but usually we have to get weaker before the market really can break down. So I'll be watching Canada and the Russell to see if they can hold up. Now, this is the new chart that Arthur Hill recommended in that article, and what he talks about is using the S&P 1500 advanced decline percent, because that's a relatively clean list for both the NYSE and the NASDAQ, and putting them together into one. What we see here is this chart is breaking out, or is holding up at new highs. The index itself is holding up at new highs, and if I use an 11-period moving average, it's still bullish. So everything looking good here. Now, if things started to roll over because the rest of the world is starting to get weak and all of a sudden the U.S. starts to follow, then I would take that information and I would add it on. At this point, we don't have any issues in the U.S. Everything is still okay in bullish mode. What I would say for the Canadian market here is we just can't get through this ceiling. We struggled here for 2 weeks already, briefly broke out to an intraday high, I think early July, and then we've rolled back over here. So, we've got an upsloping trend line here, similar in slope to this one over here. What we want to watch for is, does this start to break down? And you can see we're right near zero using a moving average. And on our advanced decline indicator, we still haven't taken out the April high, so that negative divergence is sitting there a little bit worrisome. For the Toronto, the high-low indicator never did get bullish, never did jump up into the range that we'd like to see. So again, in this low area here, you can get these rallies. And what happens off the bottom of a rally, you have lots of stocks hitting or pushing up, but they aren't making new highs yet. So on the advanced decline line, they'll move up. But until the market actually gets up closer, some of the stocks are starting to make new highs, then that's when the indicator kicks in. We continue to be stuck in a level below 50 net new highs. And as you can see, that's correlating with a weak market back in 2015-16. And so my main point here is, if the TSX doesn't get going, in 2018, TSX made its high in early mid-July. Let's just say that's where we are right now. The U.S. made its market at the end of it made its high at the end of September. So just because the Canadian market starts to roll over and break down, that would be a warning to me. It wouldn't mean that I would just sell the U.S. market outright until I saw the U.S. market start to show some signs of weakening. And we had minor moves in breadth on the bullish percent indexes. From Alexander Elder's 5-day high, so he kind of adds up 5 days in a row, and it's still very bullish, 1100, so lots going on there. Okay, the NYMO, McClellan oscillator, this is holding up at a very high level, 800. I will say that after you get kind of this initial surge, this 800 level is a place where it's worth watching. But again, as long as you're above the 400 level, it's pretty bullish, and wouldn't want to get too bearish on that. The summation index, on the last chart, I called it the McClellan oscillator. The McClellan oscillator is actually in the middle, and it is still sitting on positive side of the fence, so that's good. And the summation index is what I had talked about. Now we're going to go to a longer term look at the summation index. And we had a similar period here where we had a huge bounce off the low, then a pullback, and then the rally. And the next rally continued to go up quite well. And so is is that what we're going into? And maybe it is. I think the real thing here is it looks like the Fed wants to ease, and 19 central banks around the world are set up to ease. So it's very hard to argue with the Fed. We haven't won any time we've tried to go against that opinion. So here is the NASDAQ summation index, and it doesn't get up to the high levels like the NYSE does. But what we see here is this summation index is bouncing above zero. That's still bullish and it's trending higher. So nothing wrong with that. Bullish percent indexes. The one thing I will say to this week is there was a little bit of a tick down, and we're right at the 50% level. This isn't the place we'd really want the market to kind of tick down. So that's a bit concerning. And you can see back here in 2007, that marked a final high when it ticked over there. And it was after this sort of sideways range where the market just kind of grimaced and held together. One of the things, whether a technician or a fundamental analyst, we always have different ways of pointing out flaws in the other system. I would just suggest that, right now everybody's expecting the earnings to be declining from last year, yet the market is still breaking out to new highs. Not breaking out to new highs because earnings are going to new highs, breaking out to new highs because the Fed is going into easing. And so, it's not like the fundamentals are supporting the new highs here. We're actually getting a pullback in the fundamental data. Anyway, I throw that out because if we started to top out here, and as you can see, I mentioned this a couple of times before, but these wiggles cause kind of big movements down, and this is all compressed, right? This is 2002 to 2019. So this isn't a daily chart. Well, it's a daily chart, but it is not something that you can just kind of pinpoint to the day. But my big perspective here was that there was 5 different zones where the market kind of consolidated and couldn't really rally from. And then as it broke down, it was worth paying attention. And so obviously in 2007, after that wiggle, it rallied back up, and then that was the fail point, and then it went down from there. In 2015, we got up to the same sort of level and then wiggled and then pulled down from there, rallied up to this same similar level we're at, and that's when we had a big pullback in October. Now, the one thing I will say is that the percentage of stocks above the 200-day is much higher than it was in both of those other conditions, and more similar to like 2006, 2007. So on the rally back up, we kind of got up to this level. That still looks pretty bullish. Anyway, the point I want to make is, it would be awkward if it did break down now, because we don't have a thinning of the different industry groups. We have all of them surging nicely, whereas normally at a market top, typically we would see, breadth starting to thin, and we don't have a whole bunch of industry groups pushing higher. We don't have that right now, but I will say in September of 2018, we did have the market basically just running up to new highs, but you could see we had this downslope in bullish percent indexes. The only thing I could say is we're still way at the low end of that range, and if we were going to break down, that would be an important thing to be aware of. Now, my good friend Tom McClellan did some great work on breadth analysis, and what he found was, even though the New York Composite was littered with bonds and a bunch of other stuff, and the NASDAQ has a bunch of little piddly stocks in it, that broad view actually did tell us something. And, if you're only focused on the NASDAQ 100, you're probably going to miss a whole bunch of what's actually going on under the hood. But the big issue we would have is, every institution is invested in the NASDAQ 100. Every institution owns the S&P 500. In the Canadian market, they own the TSX 60. So you see these broad investment vehicles supporting the main indexes in an extreme way. And a lot of other stocks, if you're not in the index, you just can't even get attention. So that's the one thing that I would throw back as just, the bullish psychology is literally ETF driven now, where we kind of, if you've ever watched birds fly around, they'll all of a sudden turn and they all go the same way for a while, and then they'll turn again and all shoot the other way. Uh, we see the same thing in the markets now with the ETFs kind of pulling everything forward and back. Anyway, okay, here's NASDAQ 100, and what I want to point out on this chart is we're still up at 78%, lots of bullish momentum here, and 79% of the stocks are above their 200-day moving average. Pretty hard for the market to break down from, in an extreme way right away. I would say if anything started to happen, we might slowly break down, and then from there, as the market gets weaker, then we'd start to see it dissipate. Okay, New York Composite again, it's only at 55%, which isn't all that bullish, and we had that same sort of pause moment in 2018, rally back up and then fail. We see this in 2007 where we got up, we fell down, rallied back up, and then fell apart. This is obviously taking a longer time to play out, and I think it might yeah, well, the one thing I would say for me is that the tools have got a lot better, and so we can analyze things a lot more, but we also have a lot more breadth and momentum type investing going on. And so when the ETFs surge, they carry a lot of stocks with them. Okay, here's the bullish percent index for the S&P 500, way up here at 74%, and 75% are above their 200-day moving average. Now, that looks pretty good. It's up near the top, but the market can continue to rise while this goes through any sort of turbulence from in here. So this is bullish and should stay that way. Here's the TSX, and we're down in this 60% level, not up in the 65 to 70 that I'd like it. And we have about, 65% of the stocks that are bullish, above their 200-day moving average bullish. So that's pretty good. I think with the energy sector so weak, in order for this number to get any better, we'd need energy to get on board. Here's the bullish percent index for energy. And what I want to show you here is crude is above its 50-day moving average. The bullish percent moved above its 50-day moving average for the first time. I mean, there was a brief glimpse in May, but for the most part, it was late April. And you might remember that the stock market started to fall in May and kind of drifted lower into early June. And oil was weak in that period. Well, here we have the opposite setup where oil's actually looking like it wants to push to the top side. And we have the same thing on XLE. We haven't seen the exploration and production stocks start to break out. And you can see they're dismally hanging near the 2018 lows, that December low. These stocks are way down there. And the oil services stocks aren't much better than that. They actually went below the 2018 lows already. So 4 out of 5 of these are above their 200-day or above their 50-day moving average. That's very bullish. And what we want to see here is XOP start to follow along. Until that happens, it's a little bit iffy. But again, once they start to move above as a group, it's not a bad place to look to get long the stocks. This is the bullish percent index. And then what we're doing is we're putting a MACD on the bullish percent index. I've zeroed out the data. All of these little price labels up at the top here are from the data wildly swinging from end to end. But what I want to show you is that in this particular case, I have the oil services index and it's drilling down in the bottom right hand corner. We want to watch this turn up and start to take off. And if that was to happen, this would make a relatively nice entry on the backdrop of oil above the 50 and all that kind of stuff I just covered off. Okay, gold. I know everybody's got an interest in gold, and I have a whole bunch of bullish messages here and one bearish message. So I'm going to cover it off and make sure that you understand clearly why actually, there's 2 bearish messages, why I'm a little bit uncomfortable in gold, but I still think you want to own the rally with stops underneath. So gold is charging up and trying to break through prior highs. Here's the bullish percent index up at 65%. You would think after the rally we had, so many stocks would be bullish, but only 2/3 of them, amazingly enough. GDX is right up near the highs here, so I like this positive outperformance where the gold miners are better than the price of gold. They're actually up a little higher in their relative price chart. And GDX compared to GLD is in the top right hand corner, so that's very bullish. Okay, quickly working through some of the indexes. Next week we have options expiration week in the middle of earnings week, usually one to watch. That's kind of how we got set up in April, and we drifted higher for a week or so and then rolled over. Okay, moving on. The Fed meeting, we don't have one until the end of July, so we're going to just ignore that chart for this week. Okay, over the last month, so that's like June the 12th to now, 4.65%, very healthy gains on the S&P 500. And I drew this line in here. It's roughly this same trend line. It's a little more laid back than that, but that trend line is more, even if the market corrected back a little bit and came back to this trend line, that would be just fine. Here's the S&P breaking out to new highs, the NASDAQ composite breaking out to new highs, but the Russell falling asleep at the switch, and we're in the same level we've been at for the last 4 weeks. S&P 500, we pushed above this daily momentum indicator, which I think is very bullish. I will say the one thing that did happen in January, we had the same kind of break about, and then we took off to the upside and literally rolled over very, very quickly. So if there's anything that makes me think that this is setting up, the only thing I could say is that the rest of the world is forgetting to join the party. Okay, NASDAQ is continuing to outperform the S&P 500. Usually that's very bullish, and if it was to start breaking that trend, I'd get more worried. Amazon looks like it's going to break out to new highs here. Lots of the space looks good, so I have a hard time not staying bullish here. Okay, big picture, the NASDAQ 100 compared to the S&P 500 still outperforming, and as long as this is on an uptrend, I think you want to own the market. There was a place in here where it pulled back, and it was a good place to watch. What I'm more worried about is this big 3-year trend line breaking, and as long as it continues to hold, I think you want to own it. I don't like the PPO on this starting to be lower highs and lower lows, like if it rolled over here. That would bother me a little bit more. So we're going to be watching for that next week. Okay, New York Composite monthly chart. We're living up in the top right-hand corner of the page. All bullish, waiting to see what the PPO does here on a monthly chart. Can it get back above its signal line? It's not quite there yet. This is zoomed in on the price action, and as you can see, the monthly New York Composite, the PPO has not crossed its signal line yet. So it's a place to be concerned, and we'll keep watching that. But we do see the price up here at 13,250. That's pretty bullish. The Russell, this downtrend line is holding. Relative strength is failing. Russell breaking down. So if I had one complaint about the market, it's that the Russell isn't confirming the new highs in the large caps. So that means everybody's kind of migrating into large caps and avoiding the Russell. On this weekly chart, just in general, if the Russell was to roll over here, and it hasn't, and so what we would watch for is if momentum rolled over and went below zero. And the last time this happened, let's just run out the chart. Actually, let's run it a little wider. Anytime this momentum goes below zero is kind of a critical place on the chart. Now, it could be like this where we just wobble here. But what I don't like is that we were below zero, rallied back up, and couldn't get back above zero. And we saw that back in 2007, 2008. And it was the fact that the Russell couldn't get on board, and all of a sudden everything started to fail again. That's one of the things that we want to watch for. So a failure in momentum on that. And if I change this to the TSX and we watch the same sort of movie on it, what happens when the momentum goes to zero. So what we see here is we're still higher up, but currently looks like we're making a lower high in price momentum, and we've stalled here for the last 3 or 4 weeks at the same level. So essentially we're not getting any sort of up momentum. The Russell's the big key for me, but you remember the chart pattern on the Russell basically came down, touched, and then rolled down. That's what happened here on the TSX. So just watching for this sort of subtle move where it doesn't have enough momentum and then it rolls over. And usually that's a pretty hard rollover. So again, let's go back to the previous chart. So here's our Russell, and the momentum is just sitting here at 0. We want to see this pick up, and if it doesn't pick up and starts to fail, that's not just something that I would ignore because the large caps are doing okay. I think what would happen is if we start to see a real quick kind of selling in the small caps, that would start to put pause in our large caps. And again, I mentioned earlier that the earnings are supposed to be coming in lighter this quarter, but everybody thinks the Fed easing is going to help. And with all these central banks piling on with easing around the world, that all of them as a group are going to be able to keep the stock market moving higher. I want to believe that. I'm going to definitely try to stay on that side of the trend with the Fed doing that. We got to wait a couple of weeks for that, and once we get the Fed opinion, then we'll know if the market wants to hold out. But let's just say it rallies or pauses going into there and starts to break down after the Fed meeting. That would be a concern for me. Okay, Russell, again, we're down here at real big relative strength lows. Last time we got this low, it was after a major drop, and then we rallied out of that hole. Well, we're at this low relative momentum, and we haven't even started dropping yet. So that's one of the reasons I'm worried about the Russell. And you can see if you make this lower high here and fall apart, this is bad. In 2015, we made the lower high, and then we fell apart again over here on the right side of this trend line and fell apart. So just I wouldn't be as bullish. I don't want to see the Russell underperform anymore. I don't want to see the TSX keep stalling. I want to see these two indexes start to join the party. Okay. And I know Arthur Hill did some work on the relative strength of the IWM or I think it was the Russell he did. He uses a different method than I do, and I personally like my slope method where I just keep track of a trend in underperformance. He uses percentage change. Two different methods of doing it, and you're welcome to follow either one. In my opinion, I still like mine. I think it's more reactionary and a little closer to the bottom. So anyway, that's one thing I'm looking for. Here's the TSX right up near the top of the edge here at 16.6. Just can't seem to get any heartbeat. We've got a small uptrend that's been going off the June 1st low 6 weeks in now, but really been chopped for the last 4 weeks. And so when I look in on my portfolio, that's what I see too. We have broken this downtrend, which I thought was going to be pretty bullish. The real thing is if we're going to roll over so close to zero, this would be problematic. So try to be aware of that. And again, I don't know if it's just a gentle downward decline or if we actually go snap like that. I just don't have a feel for it. But starting to worry because this has not gone anywhere in 4 weeks and we've been at resistance. So it's starting to tell us there might not be enough horsepower in this move, and the TSX usually fails before the S&P 500. Doesn't mean the S&P 500 will follow the TSX's failure, but when the TSX is letting go, it definitely suggests that U.S. investors have something to look, some reason to be cautious if that starts to happen. Okay. Again, looking here on the weekly PPO, just zoomed in on the last few weeks. We got a flat PPO for 6 weeks now, haven't been able to do anything. Market just kind of struggling to get through here, and we don't really have enough breadth, or enough momentum. So that's the big problem. XVG is the value line geometric, and it's trying to rally back through this 40-week moving average. I was pretty bullish last week. I like to see this kind of moving up. I want to see it start to break back above these prior highs, but if it was going to stall right in here at this level again, we'd be pretty much back to a place where we don't want to be. So sorry. Let me just fix that. Thank you. So what I want to watch for in this value line geometric, if it rolls over quickly here, I'd be much more concerned because we already have a downsloping 40-week moving average, and the value geometric places everything equal and just the number of stocks. And so if all of a sudden the number of stocks are failing to hit new highs. Like everything is not like the S&P 500 where you have market weightings where Apple makes up a larger percentage than say the smallest stock on the S&P 500. The geometric just takes one for one. Is it adding them all up and weighting them equally, not share based weight? So the Shanghai composite, what we see here is this had a big rollover this week and it just barely held on to its 10-week moving average. We have a lot lower momentum here and it's accelerating to the downside this week. That's a concern. So that's another thing that bothered me. Now, I have this uptrend going in the Shanghai. When we get to the commodities, I want to see that same thing happen. But the commodities went up this week, which is really interesting. Okay, here's the Nikkei. And when I say it hasn't joined the party, remember we started to rally off the 2019 2018 lows, came up, and the S&P is already back above its September high. Look at the gap, 3,000 points on the Nikkei. It's 15% less than what the TSI or what the S&P has done. And we continue to make lower highs and lower lows. And so one of the concerns I have, and I've mentioned it many times, but if the Nikkei starts to have big problems, that underscores a whole bunch of things for me. So I'm very cautious seeing the Nikkei underperform. Now, when it starts to break down below this 21,000 level again, I'd be really concerned because there's an uptrend line that follows right under these two, and that would give me a more significant breakdown. Maybe I'll just show you that line now. And we're just going to go to my 5-year chart. And now we're going to go add a few more years, whatever 15 is good. And the point I want to make is this chart, if I annotate it, we can either draw a line off here, probably something like that would be better. And then we also have a line coming right off the bottom here if we wanted to be a little bit more aggressive, just kind of laying that out. So both of them are important, but as you can see, if we started to break down into this 21,000 level, we'd bring all of this back into play. And again, starting to break big long-term uptrends and downtrends is a concern. That's one of the things that I would be worried about. And you can clearly see a series of lower highs here. We had a brief stab up to take out the prior high and then fell apart very quickly. Now a lower high, we've had a lower low. This interim low here hasn't gone lower, but we don't have a higher high yet either. So continuing to watch which way this Nikkei unfolds. Well, let's roll on with the currencies, and I'm going to hustle through the currencies because there wasn't a lot. There's some interesting stuff on the Aussie, but all the other ones were kind of just there. So US dollar again, big week last week. This week reversed a little bit, but still in the top half of that candle. So we can't really say that, okay, that was just a false push up and now it's definitely going to go lower. That's what commodities are trying to tell me this week. And so I'm continuing to watch and see. Based on the US dollar, this is daily chart going back to 2010. Lots of wiggles on here. Trying to hold above the 200-day moving average, pretty much sitting right on it for the weekend. And this 97.5 line up here in red is a critical support resistance layer. We do have this downtrending special K line that Martin Pring calculates out. And we broke this green uptrend line in here, and that's a 1-year uptrend line. So it is worth thinking about. But my big thing is, I know President Trump wants a lower dollar, but if this is to start to go sideways and start to rally from here out of the hole, that's a big deal. And so we want to watch and see if we're getting into this sort of situation like we had in 2014. And you might remember that's when oil started to plummet, but the dollar was shooting to the moon. I don't have a feel for which way this breaks, but I would just say, we've got this really tight wound spring pretty much, and if whichever way this breaks is I think, going to send off quite a shockwave for the rest of the world. US dollar on a daily chart sitting right on the 200-day moving average and failed at the 65-day moving average, so it still looks more bearish on the daily chart, and I would say more bearish than the weekly chart, just because of this absolute stop after back testing this upsloping trend line. And if that was going down and the rest of the commodities go higher, awesome. But we're not seeing that. Now, I will say that the emerging market currencies continued to soar against the US dollar this week, so that's bullish and usually also representative of commodities. The UUP dipped below zero here on a daily chart, and if it was going to go up and roll over and fail again, this would be a good example of a last high where it just starts to fail and then all of a sudden breaks down. Lots of questions on the direction of the dollar. Don't have an answer as it keeps chopping around. Here's the euro, same idea, where it came down, made a lower low, tried to rally, but stayed in the bottom half of the bar. We're trying to figure out on this momentum trend line, is it going to just come up here and fail, or is it actually going to come up and thrust back through? Don't know. Not really much in these other euros. Let's go to the Swedish krona. There was no real help on data there. Swedish krona looks like it wants to go lower, which would be telling me the euro is going to drop lower. And what it would also tell me is that hey, maybe this chart didn't, I was going to say maybe this chart didn't update, but if the euro is going to go lower, then the US dollar goes higher. And so that's why I'm working so hard to try and figure this out right now, getting a direction on the dollar. And again, once we get that established, we'll probably have a lot more data. The Swedish krona broke this downtrend in momentum that's almost 18 weeks long, or 18 months long, rolling over, and if it would come down here and bounce, I could live with that. If this is actually just a false breakout, now it's going to start to really go weak, that would be a big deal. So need to keep watching that. British pound, no real new data there, just continuing to kind of muck about in the bottom right hand corner of the chart. Japanese yen, this one is interesting because we're watching it to see which way gold wants to break, and here's the price of gold, here's the yen, and you can see we haven't been able to break through this prior high, but gold already has broken through its prior highs. So gold is suggesting the yen is going higher, and when the yen broke that downtrend, you'll notice that that's kind of when we got the acceleration in gold, starting to break out here. Maybe I could have put this line a little bit lower, but the big thing here is all of a sudden the momentum's waning, and for the last 3 weeks we've had lower histograms on momentum on the yen, and what that means is that the slow moving average is moving, the fast moving average is starting to turn down already, or enough to slow the momentum. And so if this was just going to go right back down here, we might have a problem where gold actually just fails to keep running. That's not obvious on the GDX chart, but it's a little more obvious on the dollar gold chart. Okay, yen weekly, and we have big resistance at 95 here that we haven't got through. So just keep watching. That's why I say all of the currencies are just kind of tangled this week. We didn't get any real direction help. The Canadian dollar is trying to push up, and we did break through this trend line that goes back a year and a half. So that's one of the reasons I thought the dollar was on its way down, and everything else could continue to run as all of these momentum trend lines broke as well. So we got up above zero and we're still climbing. And so in this case, the histogram is still suggesting direction is higher, not a problem. So that's good. The Aussie dollar, when I get there, that was one thing on the Canadian dollar. If you just look at the daily PPO, it's way up at a high level, like back a year and a half. So if it was to take a breather here, who'd be surprised? Okay, the Aussie dollar, you can see pushing up against this horizontal level 70.25. And the big issue for me is if that could actually get through there, it would resume our uptrend. It would be a false breakout to the downside, and the Aussie dollar takes off to the upside. That would be how that should work. Now, here we have a year and a half trend line on the PPO. It has crossed its signal line. It is now trying to get going. If it can start to break out here, that would kind of confirm this pushback up here on the Aussie dollar. And again, if currencies or if commodities are in demand, that's the kind of thing I would expect to come from the dollar. This is zoomed in on the daily chart, and you can see we've broken this downtrend numerous times now, and we're trying to break out to the upside. I've drawn another line in here that we could use as a potential breakout level. We're just above zero, but the PPO is breaking out of this big downtrend. I think the commodity currencies want to go higher, the Canadian and the Australian one. The Canadian one looks like it needs to pause on a daily basis, but here is the emerging market currencies, and they continue to push higher like nothing ever happened. They bounced right off zero. This is a very bullish place, and so if emerging market currencies are going higher, that correlates nicely with commodities. And you can see as this has been going higher, so has gold. So the two charts work out pretty well. What I don't like is the emerging market currency PPO is starting to roll over at this high level, and that's kind of when it paused and gold chopped around up here and then fell down ultimately. But so far, we haven't seen that. So I want to keep watching. Nothing on this LIBOR chart. I went through all of the bond charts and quite frankly didn't make any notes in there. So high yield pulling back a little, but I think for the purpose of speed today and not to bore you with stuff that didn't move, I'll just keep moving. One thing that did surprise me was this BlackRock municipal yield that I like to use to help me with direction on the bonds suggests it's going to go even higher in price, which would be the price of the 10-year higher and the yield lower. I'm surprised by that. So anyway, that was one chart that caught my attention. But other than that, there wasn't a whole bunch in the bond area. Getting down through the transportation, we had a nice big push on Friday, and a little bit of that was on the back of the airline earnings from Delta, I think it was. Anyway, what we see here is, sideways jumble. The trucking industry did start to give me some signals this week. That would be interesting. I covered it off on one of my shows that I think it was Thursday, Market Watchers Live with Tom Boley and Arthur Hill. And on the show, what we noticed was I think it was Credit Suisse had downgraded all of the major U.S. trucking companies. Well, they're all about 40% off their highs, and now you downgrade them. It's almost the time you'd expect them to go the other way after being a 40% decline. So I did start to get some buy signals on the trucking group this week, which was really interesting timing after that downgrade by Credit Suisse. So continuing to watch that, but the transports are holding okay here. The full stochastic is just climbing above 50, so right now that's bullish. It hasn't broken this trend line, which is a problem. And then if it was to roll over right here, that's exactly how we'd expect it to fail. So next couple of weeks, pretty darn important on the transports. The airline specifically trying to make new 6-month highs here. That's nice. But again, you're still in this big 3-year chop with no real upside unless you're swing trading it. And here's the weekly chart on the airlines themselves. And our PPO is still below this big long-term downtrend going on for 2 years. I'm having trouble getting too bullish on that. The railroads. One of the things I'm watching for very closely is how it handles this relative strength trend line. And this is a 2-year trend line. If it starts to break down, I'm much more concerned. So far, it's holding. And, again, if all of a sudden it started to break down as the market hits new highs and fails to go higher, that would not surprise me. I'd use the railroads as a pretty good indicator of what else is going to happen. Okay, so this is the long 4-year trend line, and it's quite a bit lower than the current area on this other the other chart I just showed you. But the point I want to make is there's also a horizontal level here that goes back for the beginning of the year, and if we started to make 6-month lows, that's not a big deal, but it's this big 4-year uptrend that I would really want to see hold. And we saw this in 2015, that when the railroad uptrend ended in relative strength, it also ended in price. If that was going to start to happen, then I'd be worried that that's going to cause problems for us. And so with that, it's a bigger deal for me. I'm a bit worried about the railroads. Okay, here's trucking. And the reason I want to cover off trucking is we did get a PPO cross this week telling us it's turning up. We still haven't broken this downtrend line for a year and a half, and we're hovering right around this base level here. Now, again, if this rolls over just at 50, gets up here and fails like it did back here in 2015, this is probably a pretty classic time to expect that to happen. And we're sitting right at the 40-week moving average coming at it from the bottom side. So if we rolled over again, that would be just kind of what we'd expect. Anyway, we do have a higher low in momentum here. We haven't broken the downslope in momentum, and we haven't got above zero yet, but we got our first clue that perhaps this could start to rally for us. Autos are trying to break out to the upside, which is really an interesting case. And even when I went through all the auto charts, I didn't see any that gave me a compelling idea to buy. So maybe I'm just too negative on the space and need to check on it on a different day. Here is the broker dealers. We're sitting right at this horizontal trend line, roughly 9 months long, waiting to see if they have the courage to break out. Utilities pushing up into the top right hand corner, very, very powerful. This upsloping trend line I've drawn here on this weekly chart looks like it's about ready to crack, but we'll see if it's got any more momentum left. XLI is at the quadruple top. So we'll see if it can break through. And somebody said, nothing ever has a quadruple top, and I would point you to the TSX, and I would point you to, here's Nutrien NTR. And this stock just keeps kind of grinding at this level over the last few years, hasn't been able to go anywhere. There is no rule that says 3 and it goes up, or 4 and it goes up. Anyway, watching to see what the momentum does here. If it started to fail here, that would be a problem, obviously, as we hit the fourth test of this 79 level. Okay, one thing that had a good week, so both transports and semiconductors I mentioned in the PowerPoint at the beginning look pretty good. Here's the semis, and it pulled back all last week, and then this week rallied right from, so Monday was a doji, Tuesday pulled lower and then closed higher and then shot up for the rest of the week. That looks pretty good. And our relative strength is still holding an uptrend. So as long as all that keeps working, I think you've got to keep staying on the positive side. Let's get through the commodities because we don't have a lot of time left. Here's the CRB. We're right at the horizontal 182 level. We just keep hanging around here for years. But we did get a push up this week, and that's nice to see. Zooming in on the weekly, we actually got above the 40-week moving average on the commodities. The PPO looks like it's ready. It gave us a positive cross last week, and now it looks like it's ready to break out to the upside with a higher low. So you might remember I mentioned the Shanghai showing us the same sort of setup, but now the Shanghai has started to reverse. So I'm interested to see how commodities hold up this week in the face of a declining Shanghai. Deutsche Bank Commodity Index Tracking Fund, or Invesco Commodity Index Tracking Fund, trying to break out here to new 1 month highs. Nothing really great, but I did see a lot of signals on the commodities as I looked through different groups. So here's oil above its 10-week moving average, natural gas just barely above its 10-week moving average, gasoline and heating oil both above their 10-week moving averages this week. So that's all bullish. When all of those are above the 10-week, that's a good place to be aware of. Corn made higher highs this week. Soybeans made higher high, and wheat ticked up but didn't kind of break out yet. Looking at gold, big push on gold, and now we've got this little wiggle at the top. Silver there's a downtrend line here. It's back testing and maybe could take off out of here. If so, that would be great to get involved with that trade if you haven't already. It might set everything up. This move in aluminum, I'm really wondering if aluminum dropped 30% this week. So let's just leave that until I can find out if the data is going to correct next week. And if it does, this line should either bounce straight back up or we have to edit the data. Copper trying to hold this upsloping trend line, got back above the 10-week moving average for the first time since whatever, middle of April. So that's good. And if it rolls over right here, real bad. Anyway, inflection point for copper, definitely. Nothing there. Sugar, nothing really. Let's go to marijuana. And the reason I want to cover this one off is this chart broke down hard this week. It was down 8.6%. I've been warning for a while that the marijuana is trying to hold this level, and if it doesn't hold, be very, very concerned. And one of the reasons was we kept seeing the smaller names drip lower, and then names like Canopy Growth or whatever were holding in there. Well, now they're all starting to leave the party. And look at this relative strength line, roughly 18 months long. It's breaking this week, even if you don't ignore this little piece in here, and the only reason I did was because these other ones lined up perfectly. But if you just say that we're breaking out to new 12-month relative strength lows, I think that's going to be a problem, and we're right at the zero level down here. Typically, that's how a bull market ends. All of a sudden, it rolls into negative momentum, and everybody starts selling the stocks. So be cautious if you're in that area. Okay, coal pulled back this week, as did steel, so no real help there. And lithium and rare earth metals, same thing, down this week, but not major. This chart's interesting. This is the Goldman Sachs Commodity Index for energy, and we've got this triangle building here. And is this going to break to the upside? It is moving back above its 40-week moving average. PPO turning up right around zero. So I don't know if the Strait of Hormuz is causing this, but it looks like it's getting set up for a potential breakout. Precious metals obviously climbing higher, so that's a good one. Industrial metals. Oh, sorry, livestock. Did I miss the industrial metals? Agricultural index is just grinding sideways. Livestock. Here we go. Industrial metals, and what we've got here is this downslope here and a kind of a wedge pattern building. We'll see if it's got any breakout to the upside. Been following this trend line, and a move up here would obviously be bullish, so we want to keep watching that. But if industrial metals are unable to keep going higher, this really starts to get shaky in terms of global economic stuff. This is probably one of the biggest bullish charts this week, and that is that the total return commodity index broke through this big downtrend here and looks like it's ready to take off to the upside. So like that, and the PPO is right near zero, a turn up at zero and breaking through that trend line. Excellent. Baltic Dry Index continues to push higher. I haven't found a way to successfully use this one to invest in any of the stuff. XLE sitting right up against that trend line, trying to hold above this horizontal level, call it 63.70 or so. A push above here obviously matters. That would be good. And the PPO is already broken out, so that suggests maybe this is ready to run. Crack, the refining ETF. The PPO is back above this year-long downtrend. Love that. And this is trying to push higher than the 40-week. We're about to find out over the next 2 weeks here which way this is going to work out. Frac, we're tied down in the bottom right-hand corner. Not much going on. We're below the 50-day moving average. Until that changes, probably nothing else will. Continued downtrend. So here we are with the frac trying to bounce. We've got a full stochastic bounce out of here. Hasn't had a lot of momentum, but it's trying. We have this downtrending red line. If all of a sudden this starts to break to the upside, I'd find that very bullish and would want to get on board. West Texas crude sitting in around $60. That 64 friction level sits overhead, but so far hasn't come into play, and I expect a little bit more pressure at least to get up and test that level. Okay, here's the downtrending crude, and we're holding against this trend line, so that's an issue, but it looks like the momentum wants to turn up right here, and if this could pop to the upside and break that year-and-a-half downtrend, I think that would be major. So I don't know if it's going to be the hurricane that does that, or if it's going to be the production cuts by OPEC, or what it is, or just the lack of drilling going on with exploration and production because they can't get financing for drilling new wells. So Anyway, lots to check out in the energy sector. Here's XOP with this downtrend going back to last October. A breakout here would be pretty bullish. Obviously, a fail would be a different story. These stocks start to really break down hard and take out the December 2018 lows, which we all thought were, pretty difficult. So that's an important one. I mentioned this butterfly kind of cross here with all three inflection points, the 50, the 200, and the horizontal support and resistance. We closed above it this week, so that's pretty bullish, and we'll continue to watch for positive price action in energy. And again, on a whole bunch of my other scans I looked through, energy was one of the big winners. Let's make sure we get to the gold stocks, not much in natural gas. I will say in uranium, at the bottom of this chart, this is the weekly, and you can see that Cameco actually finally started to have a nice push up. That's a nice bar on Cameco, and if this is going to be the start of the move, you might want to keep your eyes peeled there. Got to get to copper real brief. Copper's trying to turn up here. The downward momentum seems to be slowing, so trying to break out. Looking at it on the big chart, this is the reason that I want copper to hold so much. And if the Shanghai is going to fail and this all of a sudden starts to drop below this line, I think we got bigger issues worldwide, and that'll probably show up. Gold. Getting down into this one. So gold has traded sideways really for the last 4 weeks based on the close. Lower highs and lower lows, or lower highs at least for the last 2 weeks. This week is an inside week, so a little indecisive. See this uptrend line in momentum? I do not want to see that fail. So we have a little bit of space left here, not much, but if we all of a sudden had a big move down on gold, just to say 1360 or something, and the S&P held up or went a little bit higher, that would probably be enough to trigger it. So from that perspective, it's a little bit iffy. When I go in onto the daily basis, we've actually already broken this 2-month uptrend, which bothers me. Don't like to see that at all. Anyway, it's telling me to be careful on gold and not to just be all in, because there's a whole bunch of things that are working. I will say that gold tends to follow TLT, and if I just put the two charts together, update, let's just go to daily, clean up the data a little bit, and just put gold underneath here, or on top. And the point I want to make here is that when we do this gold, see how it's outperforming on relative, or how gold shot up here, but they track each other pretty well. And all of a sudden, this uptrend, if it's going to end in the TLT, then I'd be worried that this might be the top in gold. So just not trying to scare anybody, but I would be focused on that. And Bitcoin has the same thing here, where there's an uptrend that's been a couple of months long in relative strength. As long as that holds, I think you can stay long Bitcoin. But look at the PPO; it's already starting to get pretty weak down here. And if this was to roll over and drop into a negative zone, I think all of the bullish moves and news that everybody's been telling us about on Bitcoin could quickly fade. So GLD breaking out here, but the PPO histogram starting to go sideways, losing its upside momentum. GDX is still holding up with an upslope in momentum, so I like that. The full stochastic is nice and high, so that still looks okay. The ratio of GDX to GLD soaring upward, and as long as that upward trend exists, that's a pretty positive place on the chart. I would have a trend line on there, and if that started to fail, I'd probably lighten up positions. Okay, GDX, the one thing I want to show on this chart here is the Canadian dollar. And remember I said the Canadian dollar is pushing higher. Well, this looks okay, and it looks like it wants to take off. So I think that's pretty good. And this relative strength here, I want to see that hold. So with that, that's a wrap for this week. Try and make sure that you're paying attention as we watch the rest of the world here this week. I think that could put some pressure on us. Other than that, it's a bull market. Thanks, everybody. Bye-bye.